On August 4th, we laid out a high-conviction thesis on a stock the market was treating like a speculative gamble. We predicted a structural shift where the real builders would separate from the pretenders, potentially unlocking a path to over $4 billion in annual recurring revenue. Fast forward to today, August 15th, and that thesis hasn't just held up. It has accelerated at a pace that has left short sellers scrambling. And that's exactly why so many people are asking whether the folks betting against IREN could be walking straight into serious trouble. If you've been sitting on the sidelines wondering if you missed the boat, or if you're holding shares wondering how high this run can realistically go, you're going to want to stick around for this one, because the story has genuinely shifted. If you find breakdowns like this valuable, do me one quick favor and hit that like button and subscribe. It genuinely helps the channel bring you more deep dives like this. Now, let's get into it. But to understand why this breakout is happening right now, we have to look at the massive structural divide splitting this entire sector in two. We are currently witnessing what we call the Great Bifurcation. This is the dividing line between legacy crypto miners who are still stuck relying on the volatile swings of Bitcoin and an emerging elite class of what we describe as native AI cloud architects. Here's the thing the market is finally waking up to. Demand for high-performance, Tier 4 enterprise compute has become remarkably resilient. Companies across the board are desperate for raw computing power, and they're willing to pay for it. While legacy miners are struggling to adapt, native builders like IREN have worked hard to decouple themselves from the ups and downs of Bitcoin. This isn't just about mining coins anymore. This is increasingly looking like an infrastructure pure play. And when you look at peer cloud giants like Nebius Group posting exceptional margins, or CoreWeave scaling toward gigawatt capacity, it starts to become clear that this infrastructure land grab is very, very real. And if you think this is all just theory, let's look at the cold, hard data from our technical forecast to see exactly how accurate our model turned out to be. Let's keep ourselves honest and actually audit the numbers. On August 4th, we established a projected price floor for IREN between $29 and $32. We also pointed to $42.70 as the critical technical breakout level to watch. So how did that play out? The price floor held beautifully, re-establishing itself as solid secondary support. But look at that breakout level. We didn't just approach it, we cleared $42.70 decisively, and as of today, our current support sits comfortably at $43.67. Now here's the kicker. Our quantitative model expected this breakout to take weeks. Instead, it compressed into days. This early breakout appears to have been ignited by Nebius Group's blockbuster earnings, which acted as a major sector catalyst, helping push IREN into a 146% surge year over year. Could that pace of acceleration really continue at the same rate? That's the question everyone's now wrestling with. Though in the sum, while peer earnings ignited the initial spark, it was a major regulatory filing on August 13th that seemed to pour rocket fuel on the fire. If you invest in infrastructure, you already know that construction risk is one of the biggest value killers out there. Delays, cost overruns, the endless waiting for a project to actually start generating money. But on August 13th, IREN filed a formal Form 8K that appears to have removed a huge chunk of that risk. Microsoft has officially given formal acceptance to IREN's Horizon 1 project. This is a significant milestone because it means the construction phase is complete and the lucrative billing cycle has officially begun. And here's what you have to understand. Microsoft didn't choose IREN by accident. Hyperscalers operate under incredibly strict environmental mandates, and IREN's 100% renewable energy footprint provides a structural advantage that legacy miners running on older, dirtier power grids simply can't match. So ask yourself, how many competitors can actually check that box? The list is shorter than you might think, yet satisfying Microsoft's green energy mandates is only half the battle. Your hardware stack also has to be capable of handling the most punishing workloads on the planet. This is where the elite really start to separate from the pretenders. IREN has officially achieved NVIDIA Exemplar Cloud Status on the cutting-edge GB300 NVL72 platform. And to earn that certification, your technology stack has to be capable of handling the highest density workloads in existence. We're talking about advanced liquid cooling subsystems that have to operate flawlessly under extreme continuous strain. When NVIDIA stamps their approval on your data center, it sends a signal to the entire financial world that your facility is genuinely built for the future of AI. And the market is finally starting to price in the difference between a purpose-built high-density facility and a cheap, retrofitted warehouse. because those two things are not the same, and increasingly, investors are realizing it. And that distinction between native design and cheap retrofits is the exact competitive advantage that could protect shareholder equity going forward. So let's talk about the dilution traps that have been quietly hurting retail investors in some legacy mining stocks like APLD and Hive. These companies are trying to retroactively convert old, air-cooled crypto mines into liquid-cooled AI centers. And that requires massive capital expenditure, complete physical teardowns, and it carries serious structural execution risk. Here's the painful part. To fund these desperate pivots, they often have to keep issuing new shares, which dilutes and chips away at the value of existing shareholders. IREN is playing a fundamentally different game. It was designed from inception as a blank slate for direct-to-chip liquid cooling. They don't have to tear anything down, because, at least by their design philosophy, they built it right the first time. And that gives them a genuinely strong competitive moat that's hard to replicate overnight. So how does IREN take this physical infrastructure advantage and actually translate it into a coordinated, high-margin business model? This is where the full-stack strategy really comes together. IREN isn't just acting as a simple landlord leasing out empty floor space. They're orchestrating a complete verticalized ecosystem. At the foundation, you've got the Microsoft relationship providing long-term revenue stability and major fundamental de-risking. To power all of it, they've established a $1.6 billion strategic hardware alliance with Dell Technologies. And to tie the physical hardware together, IREN executed what looks like a very shrewd $625 million acquisition of Mirantis. By owning that proprietary cloud software orchestration layer, IREN moves directly up the value chain, from being a real estate landlord to becoming a premier high-margin neocloud provider. That's a completely different category of business, and the market is starting to treat it that way. When you combine a proprietary software layer with a world-class hardware engine, the resulting financial math becomes genuinely eye-opening. So let's look at the financial engine actually driving this stock. That old narrative of sitting around waiting for volatile Bitcoin mining rewards, it's essentially dead. The new narrative is high-margin, highly predictable, contracted annual recurring revenue, or ARR for short. Right now, IREN has secured $2.8 billion in multi-year AI cloud contracts. And because they've integrated the Mirantis software layer with that $1.6 billion Dell hardware engine, they've officially revised their 2026 ARR target to over $4 billion. Let that number sink in for a second. A $4 billion contracted revenue target for a company that was being valued as a struggling crypto miner barely a year ago. Could anyone have realistically predicted a turnaround that dramatic in such a short window? That's the kind of shift that makes people do a double take. But the real magic here isn't just the sheer size of the revenue. It's the hyper-efficient way IREN generates it. And if you want to understand why Wall Street is suddenly willing to pay a serious premium for IREN, you have to look at this revenue multiplier effect. Under a standard colocation leasing model, where you simply rent out space, power, and cooling to a third party, you can typically expect to generate somewhere around $2 million to $2.5 million per megawatt. But because IREN runs a fully verticalized, high-density neocloud model, they're reportedly generating an astonishing $10 million to $20 million per megawatt. That's a 5 to 10 times improvement in capital efficiency. And that gap is precisely the reason IREN commands premium technology multiples, while many legacy competitors remain trapped in low-margin commodity leasing. Same physical footprint, radically different economics. That's the whole ballgame. When smart money sees a multiplier like that on capital efficiency, they don't just sit on their hands, they start building a position, and that's exactly what appears to be happening. Look no further than Goldman Sachs, who recently disclosed a substantial 9.4% equity stake in IREN. Now here's what's genuinely entertaining about this. While Goldman's research arm maintains a fairly conservative neutral rating with a $50 price target, their asset management division has been aggressively accumulating nearly a tenth of the entire company. This kind of discrepancy is what we like to call the validated crossover signal. When some of the world's most sophisticated institutional capital allocators effectively sidestep their own research desks to accumulate millions of shares, it tends to tell you a lot about where the conviction actually lies. It's one thing to say something in a report. It's another thing entirely to put 9.4% of your capital behind it. And while these institutions are locking up the public float, short sellers may have positioned themselves into a very uncomfortable corner. This is where the story gets genuinely interesting for retail investors. Quantitatively speaking, IREN is currently behaving like a tightly coiled spring. Because the market was slow to appreciate the full power of the AI pivot, short sellers piled into this stock in a big way. Right now, we're looking at a staggering 98.22 million shares sold short. That represents a massive 28.94% of the entire public float. Think about what that means. All of that short interest is essentially stored energy. With the institutional ownership floor rising and locking up available shares, any significant positive catalyst has the potential to trigger a sharp short covering rally. Now, nobody can promise how any of this plays out, but the setup is exactly the kind of thing that gets traders leaning forward in their seats. Could this become one of those squeezes people talk about for years? It's the question hanging over the entire trade. With that short interest looming and fundamental execution firing on multiple cylinders, where does Wall Street actually think this stock is valued? Let's look at what some of the top analysts on Wall Street are saying right now. The consensus rating currently leans toward outperform, and several of the price targets point to substantial upside. Citizens has a price target of $80. H.C. Wainwright is sitting at $90. Bernstein has set their target at $100, noting that much of the old legacy fair value skepticism has been dismantled by the recent Microsoft agreement. And at the top of the street, Compass Point is calling for $105 per share. Now, it's worth remembering that price targets are opinions, not guarantees. But this cluster of bullish targets does show that a lot of smart money is rapidly repricing IREN to reflect the reality of its operational execution. That's a meaningful shift in sentiment. Now that we've covered the fundamentals, the institutional backing, and the analyst targets, let's map out the technical battlefield. If we look closely at the technical blueprint, the path forward actually looks fairly clean. Our previously established key resistance level of $42.70 has now flipped into solid primary support. The stock is currently consolidating around our pivot level of $43.67. And beneath that, we've got a well-validated structural floor sitting at $34.14. What this technical layout offers is an interesting risk-reward profile. With the downside relatively protected by structural support, the gap between our current pivot and that top-end Wall Street target of $105 represents a wide runway for potential appreciation, assuming, of course, the company keeps executing. And that's the real caveat here. The technicals set the stage, but execution writes the story. So how do you actually approach a setup like this, depending on your specific style and time horizon? If you're a short-term swing trader, the tactical game plan is fairly straightforward. Keep a close eye on that $43.67 pivot level. Watch for consolidation above the flipped $42.70 support, and stay alert for that large short interest to potentially ignite the moment the stock breaches recent highs. But if you're a long-term shareholder, your focus should really be on the upcoming earnings report. That event is the primary fundamental mechanism to validate the ramp-up toward that $4 billion contracted revenue target. The approach there is simpler. Hold through the short-term noise, and let the fundamental execution do the heavy lifting over time. Different strategies, same underlying thesis. When we synthesize the technical setups, the commercial contracts, and the technology moats, we're left with a pretty clear picture. But before the final verdict, let's cover something important. Now, quick but genuinely important disclaimer. Everything I've shared in this video is for educational and informational purposes only. I am not a financial advisor, and nothing here should be taken as personalized investment advice or a recommendation to buy or sell any security. Stocks, and especially high volatility names like this one, carry real risk, and you can absolutely lose money. Price targets and forecasts are opinions, not guarantees, and past performance never guarantees future results. Please do your own thorough research and consider speaking with a licensed financial professional before making any investment decisions. Your money, your responsibility, so treat it that way. With that said, here's the bottom line. IREN has so far navigated a difficult crossover from legacy crypto mining toward a more structural AI reality. They've secured meaningful hyperscaler validation with Microsoft and achieved elite NVIDIA Exemplar Status. They've verticalized their business model through the Mirantis software acquisition, which appears to give them a substantial revenue efficiency edge over standard colocation competitors. Much of the dilution risk that plagues legacy peers has been mitigated by their cleaner design and balance sheet, and they're now backed by some of the heaviest hitters on Wall Street. Whether all of this fully plays out is something only time will tell, but the setup is undeniably one of the most compelling in this cycle. So now I want to hear from you. If you had to bet on where IREN lands by the end of 2026, somewhere near that $34 floor, or all the way up toward that $105 target, which way would you lean, and why? Drop your honest take in the comments below, because I read them and I genuinely love seeing where this community stands. And if this breakdown brought you real value, please take 1 second to smash that like button and hit subscribe so you never miss the next deep dive. Thanks so much for watching, and I'll see you in the next one.